Hey everyone! Welcome back to our channel. I hope you're all doing great today. If you're new here, don't forget to subscribe and hit that notification bell to keep up with all our latest content. Today, we're diving into a topic that's crucial for anyone interested in investing: diversification. So, let's get into it. Have you ever heard the phrase, "Don't put all your eggs in one basket"? Well, this saying is at the heart of investing, and it introduces us to the concept of diversification. But what exactly does diversification mean, and why is it so important? Let's break it down. Diversification is a risk management strategy that involves spreading your investments across different financial assets, sectors, or other categories to reduce exposure to any single asset or risk. The primary goal here is to minimize the potential negative impact on your overall portfolio. Let's consider an example. Imagine you have £10,000 to invest. If you decide to put all of that money into a single stock, say, a tech company like XYZ Corp, and that company faces a sudden downturn, your entire investment could take a huge hit. However, if you diversify and spread that £10,000 across multiple stocks, let's say some in technology, some in healthcare, and others in consumer goods, you reduce the risk associated with any one company's poor performance. According to historical market data, a diversified portfolio can often yield more stable returns over time compared to a concentrated one. For instance, a study by Vanguard showed that a portfolio consisting of both stocks and bonds can provide a smoother ride through market fluctuations. Why? Because when stocks are down, bonds may perform well, and vice versa. Moreover, diversification isn't just limited to stocks. It can also include bonds, real estate, commodities, and even cash. This is what we call asset allocation. A well-diversified portfolio might look something like this: 40% in US stocks, 20% in international stocks, 20% in bonds, and 20% in real estate. By having a mix, you're better positioned to weather different economic climates. Now, let's talk about the types of diversification. There are two main types. One, across asset classes. This means investing in different types of assets. For example, you might invest in stocks, bonds, real estate, and commodities. Each of these asset classes generally responds differently to market conditions. 2. Within asset classes. This means investing in various sectors or industries within a specific asset class. For instance, if you invest in stocks, you might choose to buy shares from tech companies, healthcare firms, and retail businesses. This further spreads your risk even within one category of investment. A common misconception is that diversification means having a large number of investments. While having many different assets can help, it's essential to ensure that these investments are not closely correlated. For example, owning shares in several different tech companies may not provide much diversification if they are all affected by the same market trends or economic factors. Let's look at some data to illustrate this. According to a study by Morningstar, a diversified portfolio of US stocks and bonds earned an average annual return of around 9.2% over the past 30 years. In contrast, portfolios that were heavily concentrated in specific sectors like technology or energy often experienced much higher volatility, which can lead to considerable losses in downturns. But what about the downside of diversification? Can there be too much of a good thing? Absolutely. One potential pitfall is that over-diversifying, having too many investments, can dilute your returns. If you spread your money too thin, you may find it challenging to achieve significant gains because even if one or two assets perform well, the overall impact on your portfolio might be minimal. Therefore, finding the right balance is key. To sum it all up, diversification is a fundamental strategy in investing that helps manage risk by spreading your investments across various assets and sectors. It's crucial for building a resilient portfolio that can withstand market fluctuations. Remember, while diversification can help mitigate risk, it doesn't guarantee profits or protect against losses. So, what's the next step? If you're just starting out, consider assessing your current investments and see if they are well diversified. If you're unsure about how to create a diversified portfolio, think about consulting with a financial advisor. Thank you for watching. If you found this video helpful, please give it a thumbs up, share it with your friends, and leave a comment below with your thoughts on diversification. And if you have any questions, don't hesitate to ask. Until next time, happy investing!